Let me start with something that might sound a little controversial. ICT is not complicated. What is complicated is the way it's taught. And if you've been trading for a while, if you've studied liquidity, order blocks, fair value gaps, but you still feel inconsistent, this video is going to explain exactly why. Because here's what usually happens. Most traders don't feel confused at the beginning. They feel confused after they've learned the concepts, right? And that confusion slowly turns into frustration, then self-doubt, then overtrading. Not because they're doing something wrong, but because something essential was missing from the start. Now, I want to be clear about something up front. This is not a video where I'm going to give you a setup, and I'm not going to go and show you entries and confirmations or an A+ model. This video is about understanding why everything that you've learned feels so disjointed and why learning more hasn't fixed that. Over the years, I've noticed the same pattern. Traders don't struggle because ICT doesn't work. It clearly does, but they struggle because they were taught it in pieces before they were really ever taught the structure. And when you learn things in the wrong order, nothing compounds, right? So if ICT feels complicated to you, it's not because you're slow, it's not because you lack discipline, it's because the framework was introduced backwards. And once you see that, a lot of things start to make sense. Here's where most traders go wrong, and it's not obvious at first. When something doesn't work in trading, the natural response is to add more. More concepts, more tools, more confirmation. Liquidity didn't work the way you expected, so you add fair value gaps, and that didn't fix it, so you add another model and another session or another rule, and that's exactly why more concepts doesn't mean better trading. At some point, your chart stops being analysis and starts becoming a checklist, and you've got all sorts of stuff. Kill zones, PD arrays, the Venom order block, the Reaper breaker, the grey pools, and so on and so on and so on. And eventually it can get overwhelming to a point where there's so many things on your chart that now you're lost. And you're not trading anymore, you're searching. And the frustrating part is you're not guessing blindly. You actually know the concepts. You can explain them, and you've put the work in, but somehow the more you learn, the less confident you feel. That's because more concepts doesn't create clarity, they create noise, and noise feels like complexity. But complexity isn't the real problem. The real problem is that none of this information was ever organized. Now, I want to be very clear about something here. This is obviously not an attack on ICT. ICT concepts work, and I've made a lot of money over the years using them, and so have many others. The issue isn't what is taught. The issue is the order in which it's taught. Most traders are introduced to ICT through individual concepts like order blocks, fair value gaps, breakers, and each concept is taught almost like a standalone tool. You're told what it is, how to draw it, and what it might do. But what's rarely explained is how these concepts relate to each other. Which one actually matters first? Which one matters only sometimes? And which ones are completely irrelevant without context? So traders do what makes sense, right? They stack them. There's an order block with a fair value gap during a specific session, and when it works, they think that they found the answer. When it doesn't, they assume they've missed a rule. But stacking concepts doesn't create structure, it creates dependency. You're always waiting for one more confirmation, and because there's no hierarchy, every chart feels different. This is where most traders start to doubt themselves. You see what looks like a perfect setup. You've got a clean liquidity, clean structure, all the boxes are ticked, and sometimes it works beautifully, other times it fails almost immediately. And that leads to confusion. Sometimes it works and sometimes it doesn't. When that happens, the natural question becomes, what did I miss? Did I enter too early? Was it the wrong session? Did I forget a rule? This is where people start telling themselves that the market is random and ICT doesn't work, or that they're just unlucky. But if the market were random, the same things wouldn't work sometimes. Random systems don't repeat. What you're experiencing isn't randomness, it's missing context. The setup didn't change, the trader didn't change. What changed was the environment the setup appeared in, and this is the frustrating part. You can do everything right and still feel wrong, because no one ever explained how to read the environment first. Let me show you an example here. Many students come to me with similar questions. Why did the setup work here, but fail here? Now, in this particular example, we have these two down close candles. And these constitute a high probability bullish order block, right? Price trades through the opening price of the order block. That signals a change in state of delivery. It returns back into the order block, and that's coupled with the presence of this buy-side imbalance or the fair value gap. We see support inside of that area, and the market runs higher for buy-side liquidity. Now that's textbook, right? Return to order block, fair value gap, it works. But now we have another situation here where again, we have the same setup. We have our order block. We've seen the change in state of delivery, prices run higher, return back into the fair value gap coupled with the order block, and then it's gone lower. What happened there? Now, when you understand context, you were never looking at this as an order block. You were looking at it as a breaker because you are already anticipating this fair value gap to be what? An inversion fair value gap. We was never looking for support there. We was always looking for the market to trade back into that area for mitigation and a place where we would enter short. And the main thing why traders get confused on this is because they're just trading. They're literally trading patterns, but patterns without context is just trading patterns for the sake of trading patterns. You may as well trade a bull flag or a bear flag or trend lines. It's all the same. The market doesn't move in price alone, it moves in price and time. And when you ignore time, price actually becomes very confusing. Think about it this way. If you only look at price, you're seeing half the picture. Time isn't just when something happens, time is information. It tells you why something happens. This is why the same order block can work one day and completely fail the next. Because an order block is actually a block of time that orders a change in state of delivery. The time this occurs is important. The structure didn't change. The candle didn't change. What changed was when it appeared. This is when time and price meet right here. This is when the algorithm is instructed to deliver price at a predetermined level at a predetermined time. Most ICT content teaches what to look for. Very little time is explained on when it matters. So traders treat every occurrence of a concept as equal. And when everything looks equal, decision making literally becomes impossible. So if ICT ever felt complicated to you, it's because you were trying to understand a two-dimensional system with one-dimensional thinking. Once you add time into the picture, the market becomes way quieter because the real issue isn't the concepts, it's the order in which the traders are taught to use them. Most traders approach the market from the bottom up. They start by asking one question: where do I enter? So they look for a model, a confirmation, a pattern, and then they work backwards trying to justify it. This creates a very specific feeling. Every trade feels like a decision, every chart feels different, and every week feels like starting all over, but the market doesn't move that way. It moves from top down. First, there is context, then there is directional bias, then there's time, and then only when this sequence is in order does the execution even matter. The execution isn't the solution. Execution is the expression of everything that comes before it. It's the last thing in the sequence. You could be very sloppy on your execution, but if this part here is right, you can still do very well. If the higher time frame levels are unclear, execution will always feel stressful. This is why learning never compounds, because traders keep adding information at the wrong level. You can't build a house by starting with the roof, right? This is where a lot of traders get stuck in a loop. They think that the solution is more screen time, more chart time, more backtesting, more repetition, and on the surface that makes sense. If you repeat something enough times, you expect it to click, but repetition only works after having structure. If there's no framework guiding what you're looking for, every chart becomes a new decision. Every session feels different, and repetition just reinforces confusion. This is why traders can spend years watching charts and still hesitate, still second guess, still feel unsure when it matters. The issue isn't effort. The issue is that effort without structure creates noise. Now, take a look at this chart over here. This chart is from a recent student of mine that came to me with a problem that the majority of my students come to me with. They understand some of the concepts and chart patterns, but they never have structure or context behind which levels they should focus on. All of this noise makes it extremely difficult to trade. This is what the chart looked like after I walked him through it. We removed the noise and focused on the important levels that gave us structure and context that allows us to determine when key levels will form setups that are actually tradable. And these are happening all at specific times. When key levels will align with time, and that's when the algorithm will deliver instruction. Once you have a structure, repetition becomes powerful, but without it, you're just collecting experiences, not building understanding. So if repetition doesn't fix the problem and more concepts doesn't fix the problem, then the real question becomes, what should come first? Before models, before setups, before entries, there is market narrative. And understanding why and when price should move is extremely important. And one of the ways we can do this is to understand and interpret the data inside of this, the economic calendar. This acts like a TV guide of when volatility will come into the marketplace. This gives us the when, and the narrative gives us the where. Where is the market going, and why is it going there? This is when structure becomes context, and context becomes tradable setups. Most traders are trained to hunt patterns. They scan charts looking for shapes, but structure isn't a pattern, structure is context. It tells you what matters. This is exactly why I focus so much on the one candle itself, because the candle isn't random, it contains structure. Most traders just don't know how to read it yet. This candle contains all the structure that you need in the form of price points. We have the highest price, the lowest price, the mid price, or the fair price between the highest price and the lowest price. I refer to this as fair value. And then we have the price points in between those levels. I call these levels DRT levels. Now, there are rules around them and how we use them. I have many videos on this channel that explains them in more detail, but understanding that the algorithm will refer to these price points is very important, especially when it refers to them. Another really important price level is the opening price. When we are bullish and we anticipate price to go higher, we want to see it drop below the opening price first. And again, you need to understand narrative first, and that can't be taught just in a single video. That's why I run a mentorship program taking you over real-time price charts. But here's a gem that you can go and backtest. Just like we can grade the range on every candle, which is the range the algorithm deals inside of, or a dealing range more specifically, we can apply that to the wick from the opening price to the very low of the candle over here. Now, once this wick is formed, on a lower time frame, we can use these graded levels to look for key areas that give us context and framework to a trade idea. So once we are established why price has bounced from this level, and we see the low form, we can use these price points to get in line with a directional move higher. Not only can this assess order flow and gain insight into what price is actually reaching for, this is all a part of understanding market narrative. Without narrative, the entry doesn't matter, because used in the wrong context, nothing works. No chart pattern, no order block, no fair value gap will do what you think it's supposed to do. This is why it feels like sometimes the concepts work and sometimes they don't. If you want to understand this deeper, then you're welcome to apply for my mentorship program. Enrollment opens next month for 1 week only. Click the link in the description below for more details, and I'll see you soon.